So I'd like to start. Our first conversation this morning will be with Spencer Couts, who joined us on our faculty 4 years ago. Is that right? And Spencer is the rare I'm thrilled that we have these people who actually did real world things before they came into academia. Spencer got an MRed from here at USC. He worked in the real estate development business, and then he went on to get a PhD in finance at Ohio State. And for those who don't know, Ohio State is one of the finest finance departments in the country. Probably Renee Stoltz, who was the editor of Journal of Finance, is as well known as any faculty member in finance in the country. So there is no better place to be trained. And Spencer does really interesting work on fund governance. And I think, we heard the Larry Fink quote yesterday about he was embarrassed about ESG, but all three of them are real things, right? And governance, the G part is really important. We see what happens when companies are governed poorly. You don't get good outcomes. And countries that don't have transparent government governance for their companies don't get investment. And one of the reasons money keeps coming to the US, I think it's one of the reasons, is because people value the transparency of how companies work in the US and how reporting has to be honest and how incentives more or less line up between principals and agents. There are imperfections there. And so Spencer, I remember when he came and gave his job talk, it was about this issue of what's the right amount of liquidity to keep around in a fund. And it was, I think it's fair to say his results are there's not a consensus behind his results in the world, but I think he makes his views very compelling, and it will lead to a really good conversation. So Spencer, thanks for being here.
Thank you. Thank you, Richard. Thank you, Gail. Appreciate it. Appreciate the opportunity to be here with you today. I'm glad that one of my former students is in the class. Josh, thanks for being here. Makes me feel more at ease, like I'm teaching, an executive MBA class instead of teaching on talking about my research. But anyway, it's a fun topic that we're going to talk about today. I think it's a very topical topic. It's a very hot topic right now for the past 6 months or so in real estate. I like this, I sort of timed the market with my research maybe 4 years ago. I'm just joking around when I say that. Obviously, you can't predict. But I think it's an important topic. And I would say at the time, it was cutting edge. It was the first paper on the subject. But let me sort of talk about what I'm going to talk about today. I'm motivated by 2 slides from the Wall Street Journal. The first one is from October 31st of last year. Public REITs are down, non-traded REITs are up. Which is right, or where are the values? So the valuations question, right? And then the next question is a month later, you've got BREIT that they put up their gates. They stopped letting investors come out, right? And so this was a huge conversation that was happening at the time. I've got a really good friend of mine that's at AEW, Director of Acquisitions, and he said it was the topic everybody was talking about, for the next couple of weeks was this specific topic. There was a lot of conversation on it. And so let's step back real quick and think about implicitly, what are we talking about with that? There's 2 academic, papers or ways to look at it. I'd say Geltner is probably, David Geltner from MIT is probably most famous for this line of research. But what we're talking about is the reported price, ours reported, E meaning economic, what the true maybe underlying value would be. So you go back to Blundell and Ward, 1987, and this is a real estate paper where they're looking at the reported price of these illiquid assets, real estate assets. We don't know the true value of them, but we're going to report them of what we guess it's going to be. And so what they're saying, there's an appraisal bias in it where the reported value is some average of the economic, what the true value is today, and some average of last quarter's reported. So we're just going to update it, right? We don't know what the true value is, so we're going to update it a little bit. And this creates a staleness in the prices. Okay, so they're not 100% what the true price will be today. Another way to look at it is Getmonsky Lomacher of 2004. They have a paper where it's a weighted average of the returns today are weighted average of K, 8 periods, 4 periods, 3 periods, whatever it might be. In hedge funds, this is a hedge fund paper. In hedge funds, maybe illiquid assets, maybe it's 2 quarters instead of real estate that's a little bit more stale, which would be longer. But what we mean by that is that, so let's say that, again, let's not use real estate, but let's think about with sovereign debt. Saudi Arabia debt, people buy that and they trade it back and forth. It's on your books. You have to report a fair value estimate. We're required to put, Josh, right? You have to put a fair value estimate on what it's valued at today, the assets that are on your books. Last month it was trading at 100, so you know the true economic value is 100. It's not trading today or this month. You don't know what the true value is. The S&P 500 went up 20%, or it went down 20% or 50%, or whatever it went up or down. And so you know it had to have gone up to a certain degree, but you don't know how much. And so what these econometric models suggest is that on average, people aren't updating it enough. So our updates are biased towards 0, if that makes sense, right? So if it should have gone up 20%, we're only updating it 10%. So all else equal, that means it's going to continue going up in the future. And the way we say that in academic language is that market pricing information is being incorporated slowly or with a lag. Okay? So it's not coming in at the true time that it should. And we're going to talk about some of the real effects of how that could influence things. And in real estate, we're more familiar with this, right? But the thing that's interesting is in traditional finance, they aren't as familiar with this topic and understanding of how it works. Okay. So the way that it would look, though, is that, again, let's say that you have, let's just assume that your red line is your economic values, and then the blue line, again, is your reported values. Then they'd be much smoother over time, and there'd also be a lag in the peaks and the troughs. Okay, so that you have a peak here, and then a 4-quarter later peak. You have a trough here, and 4-quarter later trough. And same with this, obviously this time series ended 2016, but you would see the same thing during COVID and post-COVID as well. So what I'm going to do today is I'm going to talk about 4 different papers that I'm going to give more of a high overview of sort of a large amount of research that I've done on this topic, where this flows through to a number of different questions. We're not going to dive into any one specific paper or topic in depth, but I'm happy to talk about it with you more in depth if you want to. But the first paper that I'm going to talk about is the one that Richard talked about, is can investors exploit this predictability? So you got the open-ended funds and there's staleness in the returns. Can I create a trading strategy that would be able to let me take advantage of a buy and hold investor? Somebody that just wants to go and get exposure to real estate, whether it's private real estate, to get exposure to private real estate, and can I come in and out of the fund and to take advantage of it? And then I'm going to talk about what mechanisms would deter that and what mechanisms maybe would enhance that a little bit. And it's the funnest part about this paper is that it's counterintuitive, meaning that almost every single time that I've presented this to, again, top academics, there's an individual from Stanford that was head of the AFA for a while, American Finance Association, one of the top economists, and his recommendation, it was counterintuitive. He put up a recommendation. I'm going to provide evidence that it was the wrong recommendation, and I'm going to tell you why that isn't the case in a minute. But once I explained it to him, all of a sudden it clicked, and he said the light bulb went off, and he understood what mechanism would actually do better at it. Okay, the setting will be open-ended private equity funds, private real estate funds. The second one I'm going to look at is this stale pricing, and I'm going to use a charged word here, but is this stale pricing, is it due to manipulation, or is it due to the difficulty in valuing these assets? And this isn't my word of manipulation. This is something that other academics are actually claiming is what's happening. And so my job is to go in, hey, it's an open question. Let's take a look at it and see, is it really what these academics are saying, that people are manipulating it? And so let's think about real quick, the incentives for why you might want to manipulate your returns, okay? Hey, so I overperformed a little bit better than my peers, so I'm just going to carry those returns a little bit forward, right? Underperformed, I don't want to look like I performed bad, so I'm going to carry those forward as well, right? So that's the argument that they make. The other side of it is to say, hey, it's just really hard to value these assets. And so I've got an apartment complex in San Diego. I don't know what the true value is. There's other apartment complexes in other places, or there's a McDonald's or whatever it might be. We don't know the true value of it. And so because of that, I don't update it enough. What you would hope to happen let's say there's 100 different assets or 100 different appraisers that come in and evaluate the asset, you'd hope that some would go over and that some would be under it. But what ends up happening is that the argument here for difficult valuation is that nobody wants to overestimate, nobody wants to put too much volatility into it. Nobody wants to change the price too much, so everybody underestimates the value on the value update. Okay. All right. The next question is going to say, okay, so let's say, is there a way to unsmooth these returns to come up with better estimates of the true economic returns, and more importantly, my true risk exposure? So if I'm thinking from a pension standpoint, if I am CalSTRS, CalPERS, or the USC endowment, I want to know what my true risk exposure is. What are the risks that I'm really exposed to? Okay, and then the last paper that I'm going to talk about is not necessarily 100% related. It's the new fund paper that it just came out a month ago, where we're looking at capital market assumptions from different institutional investors, asset pricing, asset management companies, JP Morgan, Morgan Stanley, BlackRock, Blackstone, their expectations for risk and return in the future, along with institutional investor consultants. And I'm going to provide some just a quick cue on that side is that we provide evidence that professional asset managers add value to their clients. So just a quick heads up on that side. You guys add value, and I'm going to show some ways that you guys do that in a minute. All right, so the first paper, the more illiquidity in the asset, the greater the smoothness or the greater the predictability. So this would create on paper, and in the first paper I provide evidence that there are strategies that you could create that on paper you could exploit this predictability or you could exploit this staleness in these open-ended funds. And I also provide evidence that investors behave consistent with these exploitation strategies. So if they were able to move in and out at will whenever they wanted to, they would take advantage of a long-term investor. So think about it this way. So NAV is at 80 right now. The true NAV is 60. I'm coming out at 80. That buy and hold investor, part of that money is going from the long-term investor to the buy and hold investor, right? So they're coming in when NAVs are too low and they're leaving when NAVs are too high, right? You could create a trading strategy. All right, however, because the counter, so illiquidity in and of itself helps to protect against these funds, and another characteristic of illiquidity. Because they're illiquid assets, it takes time to place money into the market, right? So if I have a $20 billion fund that I just raised, I'm Blackstone, I raised $40 billion, $30 billion, whatever it might be, I'm not going to go place that $30 billion in the market at one time, in one quarter. Or if I'm a closed-end fund, I'm going to take a couple of years, 2-3 years to call the capital. And on the same way, as the money's going out, I have investors that want to leave the fund. Hey, I can't. Hey, I'm fine for you to leave my fund. I'm okay with that, but I can't redeem the money immediately, or else I'll have to sell assets at a discount. Right? So it takes time to pull money from the underlying markets as well as put money into the underlying markets. And so what I'm going to provide evidence is that this mechanism is what actually protects the funds as well. So there's a risk that's created because of illiquidity. But there's also an NAV timing risk, but this illiquidity characteristic also helps to protect against that risk that is created inherently. All right, so there's two options that you could do to protect against this this second one here, right? So it takes time to place money into the market. It takes time to take money out of the market. One thing I could do is I could create a liquidity buffer. Right, so that's what banks do. In the bank setting, and this is the president of the American Finance Association made this recommendation. He said, hey, what I would recommend you do is do what the banks did and protect against this NAV timing, this fragility risk, by having large liquidity buffers. Okay, so I have more cash in. If a lot of people want to come in, I'm going to, hey, you're in my fund. I'm just going to put it in the bank, and so I've got a large amount of cash. People want to leave, I use that buffer, right? And so the problem with that, though, is that enables individuals to actually leave and enter at will when the NAVs are either overvalued or undervalued, if that makes sense. Whereas what we find in the market is the other mechanism that could work, option two, we're going to use liquidity restrictions. We'll use what are called non-discretionary liquidity restrictions or discretionary liquidity restrictions. So the discretionary ones are say, at my discretion, I'm going to put up the gates. I'm going to limit capital coming in, or I'm going to limit capital coming out. And I'm going to do that because at my discretion, because again, I don't want to sell at fire sale prices or buy at fire purchase prices, right? Okay, so what I find an interesting aspect of it is that the Qs going into the funds and going out of the funds are correlated with these exploitation strategies that would exploit the NAVs being overvalued or undervalued. So that those NAV timing strategies that would be most profitable at those times when they'd be profitable, so that's the time series, and then the cross section, those funds that would be most profitable. So let's say we take American Realty Advisors or J.P. Morgan, Morgan Stanley, whoever they are, and say whatever that fund is that I would be able to exploit and take advantage of that stale pricing. Those funds, both in the time series and in the cross section, have the largest Qs going in and out. So they're correlated positively with those exploitation strategies. All right, so then what I find then what's interesting about that is that's similar to the IPO literature. So the IPO literature says that those IPOs that are the most profitable are the ones that are most oversubscribed. All right, and it's the same aspect with these funds as well. All right, so the net, the Q adjusted return after you go through the Qs, then you can't actually take advantage of it. So on paper it looks great, but by the time you go through the Qs to get the realized returns, you actually aren't outperforming. So you can't take advantage of the predictability and the staleness in the returns any longer. So the queuing mechanism actually protects against this exploitation. So it's a natural secondary benefit that comes from the illiquidity. All right, so big picture net takeaway would be the key intuition with it is the greater the illiquidity, the greater the predictability. Again, so you have hedge funds, you have sovereign debt interest rate swaps that are a little bit illiquid, they're also a little bit predictable. Then you get to real estate, which is much more liquid, much more predictable. And on the other side of it, it takes longer to place and redeem capital as well. So the protective mechanism there helps to protect against that NAV timing strategy or the fragility risk that's there. And then I'll just go back then to the governance aspect of it. Then that would suggest that the funds are doing a good job by keeping very little excess cash. You don't want to hold excess cash. And I'll just put on a minor note, little asterisk there. There are similar open-ended funds, mutual funds that are German open-ended real estate funds that use large cash buffers, up to 35 to 40% cash, to try to protect against it. And they have failed in the past. All right, so that's somewhat evidence, marginal evidence of what I'm talking about here. Okay, and I'll just one other note on this is that the average cash holdings of these funds is around 3%, which is what we would hope. So it's the right thing. They're doing the right thing. All right, so here's the somewhat controversial topic now on this. It would suggest then that Blackstone did the right thing by putting up their Qs, by limiting people to be able to redeem the cash because at that time their NAVs were likely overvalued, right? So going back to that first slide. And again, it isn't, I'll provide some evidence in a minute of why that's the case. Again, but let me show you just graphically what I mean by this. So here is just in the cross section of returns. So we got quintiles, 1, 2, 3, 4, and 5 of their prior 4-quarter returns and their future 1-quarter returns. And so you're able to predict. And so if you're able to come in and out, I could buy the highest fund. However, the Qs are also positively correlated with those funds that also perform. So that net, so you look at the red bars, there's not much superior performance in that. Okay, and it's the same with in the time series as well. All right, so this motivates then my next paper, which maybe this could have been written by one of you guys, but I posted this online, I posted this on LinkedIn and said, hey, Blackstone's doing the right thing by putting up their Qs, because if you're a long-term investor, you don't want them to be able to let people come out with high NAVs. And I got a message from somebody on LinkedIn that said, hey, that's all great and dandy, but we all know that they're manipulating it. They're choosing to have the NAVs that are, let's see what this is. If the managers are realistic, this opinion will never happen. The greed of all these investment managers to increase their NAV, not being truthful about the broader market and the value, creates these. And it might have been written by you. I don't remember who it was. So I apologize if it was. I'm not putting your names out there. But the idea was, hey, let's take a look at this. It's an open question. I'm an academic. Let me look and see. Let me see if this is, manipulation, them actually purposefully doing this or not. Okay, so in this question, what I'm going to look at are, okay, we're going to look at the smooth returns. And there's evidence that we as academics use to say, hey, these returns are smooth. What would make me think that the returns are smooth? Well, the first one is there's autocorrelation. Right, if there's significant last quarter's return is correlated with this quarter's return, significant autocorrelation would suggest, hey, there's probably smoothness in it. Because if not, the market would come in and take advantage of that and change those prices. Another one would be, we're going to look at a factor model, right? And let's just keep it simple. And we're going to just, and if you don't understand this language, we can talk afterwards. But let's think of a simple CAPM model, capital asset pricing model, okay? And we're going to look at betas and alphas. Beta is your co-movement with the market return. The more beta you have, the more risk you have, the more risk exposure you have, okay? And then alpha is your superior performance. It's whatever your return was before adding on you're taking into account your risk exposure. And so when I run a regression, and I regress the returns of the fund against the market. So if they correlate together, hey, your excess returns have no alpha, right? It's all coming through your risk exposure. But however, if there's a lag, right, they're moving like this, then all of a sudden your beta is biased towards zero, meaning that you should have your true risk exposure is there, but we're just not capturing it in the model. Okay, so your beta would be biased towards zero, your alpha would be biased away from zero. And then the third thing we look at as an academic is, hey, what are when I regress the returns today on lagged factors, what are the loadings on those? Do your betas show up there? And they do. Then you say, okay, you know what, there is smoothness there. So that's our evidence that we're looking for of some sort of smoothness. And then what I'm going to look at and say, like, I'm going to distinguish between internally valued assets and externally valued assets. And say which ones are smoother, which ones have more biases, and the alphas and the betas. And my prior was, I'm thinking the externally valued, they're going to be less smooth. And internally, they're going to be more smooth, right? So that would be evidence, for what I'm looking for is evidence that, maybe there is some sort of a conscious choice by the managers to do that. Are you nervous, Josh? No, I'm just kidding. I'm just kidding. All right, so, okay, so let's go ahead and move forward now. So the setting is going to be private equity real estate assets. What I'm going to provide evidence for is actually the conclusions I come up with, all those measures of autocorrelation, betas, alphas, lagged betas, it's all due to, majority, the vast majority, it's materially due to the difficulty in valuing the assets, and it's not due to managers consciously choosing to do it. Okay, so that's a good thing for asset managers or for the funds themselves. So my personal opinion, so it's interesting. I've got my opinions and I've got like my empirical evidence of what I can show on, right? So my personal opinion is I think that Blackstone markets very well the fact that their returns aren't correlated with the markets, but I think deep down they know. I mean, if you look at so they pick and choose the pieces to market, and they pick and choose how to represent the data, and it's very much in favor of the fact that their returns are real. And so I would say that they are, they know, I would say.
I just wanted to check, given that your story here is these guys are straight and they just don't know what they're doing. Well, not know what they're doing in the sense that they're incompetent, but like the world is just too full of uncertainties for them to know, which is the story you're telling. And I remember being kind of appalled when I saw that marketing piece come out at the time, and that's before the redemption started really rolling in. So redemption requests started really rolling in.
Yeah. No, I agree. And I think they take the naiveness of retail investors especially. And the thing about it is it's not only naiveness of retail investors, but it's also naiveness of incredibly well-trained finance professionals. finance that are not related to alternative investments. So my line of research started in 2018, 2019 when I was in the PhD program, and I saw all these CFA boards of these, we have this army of finance professionals that come from Wharton, Columbia, everywhere. And what are they looking for like their measure of, success? It's alpha. They're all looking for alpha. Right, and so, and again, I don't think I can overstate enough the importance of the beta's biased towards zero and the alpha's biased away from zero. Again, so what we're looking for here, and again, everybody in the world of finance, you go over to Marshall, it's 100% they're trained that way of they're looking for alpha. So they're running these regressions on factor models, and anything that's not captured or absorbed by these betas all of a sudden shows up in the returns of alpha. And that everybody's saying that's superior performance in investment, okay? And so you have these CFA boards that say, hey, I beat the market. I'm doing phenomenally well, and people market it over and over again of like our alpha, our superior performance is this, and you have it looks better than it is. And Blackstone is no exception to this. I think they're very good at marketing. And I think they're trying to pull the wool over people's eyes up to a certain degree. But let me get back at
Marketing, pulling the wool over people's eyes.
Yeah.
What's another word for it?
Yeah. Okay, but so, I agree. So I don't. No, it's good. So my research doesn't necessarily. That's my opinion. Right. So on my research, what I look at now is like the true returns that are there, and I'm going to. What I'm going to look at is these aspects of the betas, the alphas, and I'm going to compare external. So you've got Altus Group, like these professional experts, and they're out there valuing the assets. Do they do a much better job than the internal valuations? So if we were to have 100%, some third party do it 100% of the time, would we still have these these autocorrelations and the biases and betas and alphas? Okay, and what I find is that they're equivalent. Altus Group versus American Realty Advisors, JP Morgan, Morgan Stanley, whoever does it, whether it's Altus Group or whoever, they're equivalent in regards to their risk-adjusted returns, their factor loadings, on the lagged factors as well, with a small caveat that internal valuations have a slightly larger, maybe not even slightly, they have larger or more what I'm going to call lame valuations, okay, meaning that last quarter's value is today's quarter's value, okay? But it doesn't flow through at all to the biased alphas and betas and autocorrelations, okay? And I just don't have time to talk about it in this paper, but I provide evidence in my paper though that it's a rational reason why they do. And there's a trade-off of the marginal cost versus the marginal benefit of when they have these lame valuations or these mechanical accounting valuations. Where you just, again, it was 100 last quarter, it's 100 this quarter, or I'm just taking last quarter's value plus today's, plus CapEx to get to today's value. And the price updates as well. Once you control for the accounting updates, they're equivalent as well. Okay, so I'm not going to talk about it too much how I do this, but I create indexes based on the properties that were valued internally and indexes based on the properties that were valued externally. This is what you would hope to find if you were looking for manipulation. This would be my evidence of a conclusion that, hey, they're manipulating it, they're doing it on purpose, is that the autocorrelations would be much larger for the internal values than the external values. Similarly, the raw data, again, so we take the raw data, we regress it on a factor model, and all of a sudden we see that the alpha, it didn't change. So there was none of that return that was absorbed by the factor model, and so it stayed the same for the internals. And then the externals, a lot of it was absorbed by the contemporaneous factor model. We would say that, hey, the external evaluations are doing a much better job of incorporating market pricing information on a timely manner because it's being absorbed by the factor. And then what I would hope to also see is that once you put in the lagged factors, hey, it's all being absorbed, right? And this would be evidence of, again, manipulation. Now I'm going to show you what I find. All right, this would be the other thing I would look for as well, is that the loadings on the lagged factors, right? So what a loading means is how exposed am I to the lagged risk factor, okay? And this shows that the loadings are much more recent. Market pricing information is being incorporated much more recent. This versus, the internal. This is what I find. The autocorrelations are almost identical for internal and external valuations. So it doesn't look like the internal versus external are much worse. This is what I find on the raw, right? I was hoping to find like a difference here, but they're not different at all, right? Okay, and then on the last one, this is, again, this is my loadings on lagged factors. So this is my factor today, my risk factor a quarter ago, 2 quarters, 7 quarters ago. So I've got statistical and economically large risk factors for both internal and external. So again, what this is saying is that that they're not doing worse. Internal aren't much worse. I guess there could be an argument that could be made that that the external valuations aren't doing a better job either, as good a job as you would hope they would do. But what I'm doing in this paper is comparing to see if it's manipulation or not. All right, that being said, the price updates, there is a significantly larger price change for external valuations, but it's mostly due to, again, these lame valuations where I'm just taking last quarter's valuation and just keeping it the same. Okay, once I take that into account, the price update is not economically large. So here's a good way to visually represent like the lame valuations aspect of it. So again, where we have internal valuations versus external valuations, and so the autocorrelations, the alphas, the betas for these two different indexes are almost equivalent. However, the price change is the magnitudes. Once you remove the lame valuations, they're almost identical. So to your point, though, that the extremity of the returns is much lower. All right, now I'm going to get into my third paper. This is a fun one too. This is at the 1 yard line at the RFS, which is a top finance journal. We've answered all the questions of the editor. We're hoping that they get back to us and say yes on it. But did anybody in here know the term convolution or deconvolution? Okay, so I learned the term from a good friend of mine. He's an asset manager in a large finance company, but he also loves astronomy. Okay, so they use it in, I was getting mixed up, astronomy, astrology. Astronomy, right. So, not astrology. Not astrology, all right. So what convolution happens is when you have a telescope or microscope, it blurs the image, okay? It's the way that the optics are made. So you look at stars, and deconvolution, what it does is it takes a couple different stars and it says, hey, there's a common smoothing component to this telescope. And so you could unsmooth that one star itself and you make it really clear. Or we could take information from the surrounding stars and make it even more crisp and more clear. And so we're going to use that method with the returns of the funds themselves. And this is a really fun aspect of it. So in the literature, there's a smoothing method by David Geltner and then also David Getmansky-Lomakarov, where they use ARIMA methods to back out to come up with estimates of the economic returns. And this is important because if I'm CalPERS or CalSTRS, again, I want to know what my true risk exposure is. What are the risks that I'm really exposed to? Not the ones that you report, right? But what am I really exposed to? Because what I don't want to have happen again is that, again, let's just assume that COVID was happening right now, and we're all really, really concerned about COVID. We come here, we've got a monitor on our belt that tells us, are we exposed or we're not exposed to COVID? And I'm looking at it the whole time I'm meeting with you guys. Am I exposed? Am I exposed? I'm not. Okay, I'm good. And then I leave 30 minutes later, and all of a sudden it's like, beep, 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 beep. You're exposed to it. You're like, oh, crap. I got exposed, right? And so then this way, you want to know, how exposed am I to the market? Right, so hedge funds, real estate funds, these illiquid assets, they have this smoothing to them. We all know this, but how exposed am I to it? All right, so the methods that are out there, I'm going to call them one-step unsmoothing because they smooth at the fund level using the methods. The method we came up with is called a 3-step unsmoothing, which uses the common component of, again, the deconvolution of the different stars, so there's no difference when you look at each fund individually, right? So when you unsmooth them, right, there's no benefit in that. However, once you use our method compared to the one-step method, if you unsmooth it at the aggregate level, all of a sudden we remove the smoothing at the aggregate level as well. Okay, so here's a way to look at it from the hedge fund perspective that I think really is insightful. Okay, so you've got all these different types of strategies, from very liquid strategies to illiquid strategies, And what these different colors represents are what are the risk exposures or the factors that I'm really exposed to. And once you unsmooth them, all of a sudden you see that these event-driven strategies, hey, I'm much more exposed to the market than I thought I was. And what's really, let's look at this emerging markets, the emerging market strategy. What was the beta that increased the most? Well, the beta to emerging market factors is so the risks that I should be exposed to on these, we uncover the risk loadings increase the most on the factors that you would expect intuitively. All right, so the last paper that I'm going to talk about right now, and then we can maybe open it up for some questions if you guys want, is this new line of research that is very cutting edge. So you think about asset pricing, what explains returns? What explains what investors care about? You go back to Markowitz, I think he just passed away last week, right? Yeah, which is unfortunate. He kicked off the finance. You think about science and biology, research in those areas has been around for hundreds and hundreds of years. Whereas finance, not so much. So modern, finance theory, modern finance research started, with Harry Markowitz, I think it was 1950 or so. And most of that has been done by, we look at realized returns. So what are the realized returns that happen? We're going to regress them on a number of different factors, what we think investors care about. And what a factor means is, so you have a risk factor. So if there's a risk factor that's out there, investors want compensation for bearing that risk, right? So if I don't want that risk, you're going to have to pay me to bear that risk. The more risk that I have, the more you have to pay me, which means, how do we find that out? Prices are lower for those risks, right? So there's an inverse relationship with price and return. Okay, so now the 10 years ago or so, there was this new literature that started coming out saying like, hey, we're going to look at what people's true beliefs are, not necessarily the realized returns, because realized returns might be different than their true beliefs. So we have the subjective expectations, okay? So people would start doing surveys and ask them, what are your expectations about the future? What are your expectations about risk, about return? So here's one that's really interesting. And they asked them, they said, okay, here are 5 different assets, 1, 2, 3, 4, 5. And they said, 5 being the most risky, 1 being the least risky. What are your expectations about the future returns of those risky assets? There's a negative relationship with it, right? So how many of you have had a finance class in here? Okay, a better question. How many of you not had a finance class? Okay, so in what do they talk about in risk and return? What's the relationship? Positive relationship, right? So that's the exact opposite of what these retail investors are thinking, right? And intuitively, we can think about it this way, right? So day one, I ask my investors to come, or my students that come into class, ask them what makes a good investment, and then inherently they always say, hey, something that has good, strong demand fundamentals. Invest in that. Right? So they're not taking into account price at all, right? So there's, I'll talk about that in a minute. But so anyway, in this here, there's, it's irrational in the aspect that they expect that they're going to have higher returns for lower risk investments, right? They're most likely negative, focusing on the risk loss. But there's another way to look at it too, which is to say instead of looking across asset classes, we're going to look at within one asset class. So this is the stock market, the U.S. equity stock market, and what do you think? What do you expect for next year the stock return will be, and then also how risky it is? All right, so, and there's a number of different papers that are on this line of research, but this is sort of just, anecdotal evidence just to show, just to motivate. But nonetheless, they have a negative relationship, and this should be positive as well. There should be a positive relationship here that we find in is what actually happens in the markets. Okay, so what we've done now is for the past 8 months or a year, more than a year, I've been collecting, these capital market assumptions where I've been directly building relationships. Where's my friend from Meketa? Is she here today? She's on the board of this. Christy. Yes, Christy. Is she here today? No. Okay. So I didn't know she was going to be on this panel, but anyway, Christy and I connected 6 months ago or so. I chatted with her. So I've hand collected these capital market assumptions from different consultants and from asset managers. And it's taken a significant amount of time. So SEI, JP Morgan, Morgan Stanley. I've had calls with the chief investment officers for these different groups. How do they come up with their expectations about the future, about U.S. Equities, international equities, real estate, right? So you have all these different asset classes. And so we're able to add to the beliefs space using now not just retail investors, CEOs, CFOs, but the actual beliefs that they come up with on their own. And what we find is that they do have this positive risk-return trade-off, meaning that their expectations about the future are consistent with what actually happens in the markets. So this is this is obviously just one segment of the whole paper that we have, but this is we're providing evidence of one way that professional asset managers add value to their clients is to help them to have realistic risk-return expectations about the future. I'm going to provide one other small little tidbit on this is that, so this is Andrew Schleifer at Harvard has this paper where they look at and they ask investors, hey, what are your expectations about the future returns of the market? And they line up with the lagged, whatever happened in the last 12 months is what people think will happen in the future. And I'll motivate this by, I went to the doctor's office, a month or maybe a year ago or so, a year and a half ago, and the nurse comes in and says, hey, you have a PhD in finance. Can I ask you a question? And I'm like, sure, go ahead, right? She's like, hey, so Dogecoin, it's done phenomenally well. It's in all the news and stuff. Should I invest in it? She's like, I know nothing about it, but it's done really well. And my answer was no, you should not invest in it, right? Like for a number of reasons why. But that's her thoughts are, it's done really well in the past year, so it's going to do well in the future, which we know that's the exact opposite. There's an inverse relationship, again, with price and return, future returns, right? And so, again, this is irrational in regards to what happens in the real world with returns. And what we find is again, this is for retail investors. Now we look at institutional investors, and I'm going to take this is the CAPE measure from, Yale Schiller. Schiller came up with a CAPE, which is the inverse of the price to earnings ratio. And so it's somewhat of a yield measure that we have here, right? So future returns are correlated. So institutional investors believe that yields are related with future returns, which is the case, which is actually what we find happens in the marketplace. So again, professional asset managers add value to their clients by helping them to have rational expectations, right? So you don't have the issues that come up with GameStop and with Dogecoin and other aspects like that, where extrapolative or recency bias biases come into play, investment biases. Anyway, so that's the last that I have on my slides. I'll just wrap up with my conclusions on my the papers. So liquidity, it's related to return predictability, right? So it could create NAV timing strategies that would lead to fragility in the funds. But the illiquidity also takes time to place capital, redeem capital. So you have the Qs, which help protect the funds themselves. Is actually protecting a long-term investor. You actually want that if you're a long-term investor in these funds. Cash, on the other hand, would actually increase the fragility or increase the ability for investors to come in and out. So you do not want cash. Return smoothing. It's due to the difficulty in valuing the illiquid assets. It's not necessarily due to so the return smoothing that we observe isn't due to managers choosing. Now they could be choosing, and there could be other consequences and stuff. This doesn't mean that manipulation doesn't happen. It doesn't mean that there aren't choices that investors are making that happen that influence returns, that influence the timing of returns, and so I guess this paper is just related to this smoothing component. But I agree with you that there could be things that happen. All right, so unsmoothing now, with the unsmoothing method that we provide, you can actually get a better estimates of your true risk exposures. All right, lastly, institutional investors add value to their clients through the rational expectations of risk and return across asset classes and within asset classes. All right, that's all I have. I don't know if 4 minutes left.
5 minutes for questions.
Yeah, anybody has any questions or disagreements or, yeah.
Is there any difference in your research for when the markets are volatile one way or the other, right? So in a huge quick run up in 2021, any difference or anomalies in your research when it's not necessarily an efficiently priced market?
Yeah, that's a great question. So this is an academic question. So David Ling asked me the same question, which David is one of the top, academics in this area. He's done a ton of research on private and public real estate. And so I do have some research that looks at, differences in return buckets, saying like, okay, so extreme negative right, left or extreme right. But I have not looked into specific asset classes or property types of office versus industrial. And I do find that there isn't as I would have expected that there would have been. It's like when there's when there's less information. That so one of the things that we do know, a stylized fact about real estate is that there's more transactions in the up versus in the down. Right? People hold on to their property, so you would think there'd be less market pricing information. There'd be more staleness, is what you'd expect. I don't find that's the case, which is oddly enough. I would have expected that the other thing around. I would have expected that there would have been more staleness in the down than there would have been in the up. One thing that could counter that, a little bit of speculation, is that you're to a certain degree, a manager's incentivized to write it down, right? So if I don't want people to leave, I'm like, hey, we've already written all that down, right? So anyway, I don't. What I can talk about is what I do know is that I don't find it. So other than that, it's just pure speculation.
I have a question.
Yeah.
Funds normally don't value the whole portfolio every quarter.
Correct. Yep.
25%.
Well, it's increased over time.
Okay.
And it's become a lot more prevalent over time. I have an interesting graph on this as well. So what's neat about it is I've developed a relationship with NCREIF where they've sort of opened up the kimono and said like, hey, I can have access to all their data.
Yeah.
So I'm looking at every single property that they have. One of the things I looked at is the internal versus external over time, and it's trended up more and more. But anyway, to your question is that they do not.
Exactly.
Some funds
There's
do.
a lot of
some-
lag effect, right? Because it's not valued every quarter, the whole portfolio.
Correct.
So it's like you wait 1 year before the whole portfolio has been valued.
Correct. Well,
And-
that's external valuations.
External
they still
valuation.
have internal valuations, and that's what in my paper I look at internal versus external.
Exactly.
Yeah.
That's my point, is that there's a lot of lag on valuations.
But that being said, though, so I think that's to my point of my paper is even if you had 100%, so I create indexes based on 100% external valuations, and I find that lag still remains. It's 100% there when it's done 100% externally. And the way I started out looking at this, so I create index, internal versus external, but I started off looking at only those funds. There are certain funds that have only external valuations 100% of the time every single quarter. And so I've controlled, so I've looked at those funds versus other funds, and those funds even have, again, going back to the smoothness of, like those three metrics of smoothness of the autocorrelations of the biased alphas, biased betas, and biased lagged betas are equivalent.
Okay.
Yeah, and so that was the interesting finding on my side. I expected that it would have been different. I expected that with the external ones, there would have been less bias. Yeah.
Okay, we could go on, I think, for a long time, Spencer. This was really great, but we have to move on to our next panel. Let's thank Spencer for a really enlightening presentation.